Hi, thanks so much for tuning in. This is BQ Prime. My name is Alex Matthew, and you're tuned in to the Mutual Fund Show. And this is where we get you the insight that you need to make the right investments. And of course, we also get you a flavor of what's happening in the industry. Today will be just that sort of a chat. My guest today is the Deputy Managing Director of SBI Mutual Fund, Mr. DP Singh. Thank you so much, Mr. DP Singh, for taking the time for speaking to us. Always a pleasure speaking with you. And I think there are a lot of changes that are underway in the mutual fund industry. Let's first talk about the regulatory perspective that we've gotten in the recent past. And I think one element that your organization is spearheading has to do with the debt mutual fund space. And that is the creation of the first of its kind rescue fund, if I can call it that, which is supposed to take care of the industry in times of stress. Can you explain to us the genesis of this idea and how it's going to work?
Thank you, Alex. Thank you very much. And it's as you said, it's always a pleasure talking to you because with the very clear thought process which you come and you interact, it's always a pleasure. Now, coming back to the CDMDF fund, which has been declared when was notified after it is yet to be notified. It was announced by SEBI chairman after the SEBI board meeting, and this was in discussion for the last one and a half years. In fact, this fund was announced by Honorable Finance Minister 2 years back in the budget speech. So that is seeing the light of the day now, looks like, and we are yet to get the official confirmation from SEBI. But as the discussions are going on, I think this fund will be up and running in coming 1.5 to 2 months.
Okay.
The genesis of this fund is that when we had some credit events earlier in 2008 and thereafter, and very recently, when there was some issues regarding one of the fund houses credit issues. So that point of time, there was a run on the funds, and lots of people came for redemption out of fear. So that creates a problem because whenever such a situation happens, there's a generally liquidity crunch in the market and nobody is ready to buy these securities and buyers are not there. So how to take care of that? How to take care of the redemptions which are coming in our way? So for that, it was thought rather than fund houses being dependent upon the other players in the financial market or on the banks, why not to create a fund which will take care so that everything happens smoothly.
I think a lot of our viewers might be a little too young to remember this because we have a lot of young viewers as well. But
Yeah.
2008 financial crisis, if I'm not mistaken, the RBI had to step in to give a little liquidity,
Yeah,
right?
RBI had to step in. They opened a special repo window where they asked banks to give credit lines to the mutual funds and by buying their securities. But that was issue, and this happened once again also when RBI had to step in to tell banks to open the credit lines for the mutual funds. But those are not the things which should be done in this thing because that's done in the crisis situation. How to avoid these kind of situations and how to create a system where any such event is handled smoothly. This is a great idea, and this is already prevalent in the developed markets.
Okay,
This
but
backstop
how is
facility.
this going to work? So it's going to be mutual funds have skin in the game, and you
Yeah,
can draw as much as you put in. Is that how
yeah.
it works?
No, I'll tell you, this is a percentage of your AUM
Hmm.
has to be put in by the fund houses out of our own money. Everybody has a net worth, so we'll put a percentage. Suppose today, if my debt fund portfolio is say 1 lakh crores, so I will be putting say 0.50% of that 500 crores into
Okay.
this fund. This is just an example. This is not the actual numbers when that's yet to be notified. So we'll go. So at present, it's going to be around 3,000 to 3,500 crore fund,
Sure.
which will be put in by the fund houses, and thereafter government is facilitating a credit line by issuing a guarantee through NCGS GCT, which is the organization which gives guarantee on behalf of the government, and that will be given 90% of that. I mean, so 10% will be put in by the fund houses, 90% will be a credit line which will be activated whenever such an event happens.
Okay.
So this 3,000 crore, whatever will be putting, will be run as an alternative investment fund,
Mm.
as per the new chapter which is going to be notified
Mm.
as declared by respected chairperson.
Savages.
Yeah, so that's how it is going to be. So it will be there whenever there's a credit event, as Madam rightly said, with the push of button, this can be
Who
activated.
pushes that button?
SEBI,
Okay. So
SEBI will
SEBI
push it.
takes that
Yeah,
call.
SEBI takes that call.
Okay. So and SBI Mutual Fund is managing this
We
fund.
are just managers. We are just fund managers for
Understood.
this. Yeah,
So it's a great development, and it's something that is, from a prudential standpoint, a great
yeah,
step for the
yes,
industry as a whole. This is one of the recent changes that has taken
yeah,
place.
yeah,
The other change with regard to the debt mutual fund space is the change in the taxation norms, and that kicks in from the 1st of April,
yeah,
from the new financial year. All new investments into debt mutual funds will, the gains of those will now be treated as short term capital gains and
yeah,
will be taxed at the slab rate. Now, this is a
yeah,
benefit that I think debt mutual funds enjoyed for quite a while. And there was a routing of capital from fixed deposits into this.
yeah.
Do you think that while there was a need to bring a level playing field, to a certain extent, there will be a negative impact on the ability to sell these products?
See, there were three benefits of putting money in debt mutual fund, and three major benefits. One, you are not getting the interest income; you are getting the capital gains,
Hmm.
which continues as it is.
Right.
Okay, it's not a long-term capital gain after 3 years, so on and so forth, but it's a short-term capital gain, but it is a capital gain. Second benefit was that you are not paying any tax till the time you redeem,
Hmm.
and that benefit continues.
Right.
Third benefit was if you are having it more than 3 years, you get the benefit of indexation.
Hmm.
So that has been withdrawn.
Right.
But the two major benefits still continue,
Hmm.
because the first benefit of see having it as a capital gain, not as an interest income,
Hmm.
is the meaning thereby that the tax liability will happen at the time of redemption.
Hmm.
So one, you are deferring the payment of tax.
Correct.
Because in the fixed deposits or any,
Every year.
you pay your TDS is deducted,
Mm.
and even though income tax laws allow that you can make the payment of tax at the time of maturity, but since the TDS is deducted
Mm.
every quarter,
Mm.
so it becomes very difficult because it will come in under in your this income
26
tax
years. Correct.
26A, and then how do you go and convince this thing, no, no, give me a refund, I will get it tax
Mm.
this. So it becomes a problem. So everybody is paying on the poor. So that is a major benefit. And the third benefit is, see, debt funds are a cyclical thing. Today, people who are putting in long duration debt funds are not putting because of the YTMs alone.
Mm.
They are playing around with this thing. When the markets, when the interest rates will come down, they will have the probability of good capital gains.
Mm.
That is not possible in fixed coupon products at all,
Yes.
and fixed deposit at all. Yes, they can go and buy a security directly from the market, but then you don't get the benefit of portfolio. The risk is concentrated in
Mm.
one or two. When you are putting through mutual fund in a debt fund, your risk is diversified in
Yes.
various.
Right.
There are 10, 15 securities. There are very, very strong the risk
Issuers of
issues,
debt.
and there are very, very good risk management parameters which has been brought in by SEBI in the
Mm.
interest of investors. So all these benefits they will not have,
Mm.
and when they're doing it. So comparing with FDR, comparing with the direct investment in the
Bonds. Yeah.
NCDs or bonds, still the debt mutual fund score very, very high. So one benefit has been taken away,
Sure.
but that's not end of the day. But and when I look at the number, when I do the deep dive at the numbers,
Mm.
how many people are getting the benefit of indexation?
Of
The
holding
number
beyond 3
is
years. Right.
very, very minuscule, very minuscule.
Interesting.
And the second thing is the kind of education about debt mutual fund which has come up because of the media conversation, the way we are talking today. And number of people are not even aware that the indexation benefits are available.
Right.
Now, when something goes, then people miss out here.
Yeah.
And
So
some people are even now. When I came to know one of my friends who is in distribution, that some of his clients came to him, "Okay, why did you not tell me in advance? I'm coming to know from media that there's something
Right.
like this is
So,
there."
but we've closed
Yeah.
the financial year, sir. Did you see a rush to the debt mutual fund?
Not rush, but yes, there was an interest. We got industry got good money, but it's not very very widespread. Again,
Mm.
it's concentrated.
Okay.
See, the message goes, and then see, acting upon that within a span of 4 or 5 days,
Mm. It's not
it's
easy.
not it's not
Mobilizing
it's
of
not it's
funds and
not
all of
easy.
that.
But yes, some of the smart players, some of the evolved wealth counters, they have definitely
Like you said, the
exploited
fear of
situation.
missing out is
Yeah, yeah,
actually
yeah, yeah,
something that comes into
yeah, yeah.
play. Um, do you think that there is going to be a need now to change the messaging and the strategy to educate people about debt mutual funds will be a little more nuanced than it has been? Previously, it was easy. You could say, why are you putting money in a 5-year fixed deposit? Put the same amount of money in a debt mutual fund, you'll get indexation benefits. There are a lot of benefits to hold, apart from the ones that you've already spoken
No,
about.
I will call it the other way around. It will
Okay.
become much easier now to talk about debt mutual
Okay.
funds because people are aware. Now I compare it with the mutual fund Sahi Hai campaign.
Mm.
Earlier, everybody was skeptical. No, 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 don't touch mutual fund. Mutual funds, mein to it's like a crucial. You will burn your fingers and all. And after the mutual fund Sahi Hai, that narrative went off.
Right.
Okay. Now with these things happening, I feel as a marketeer, this my gut feel that lots of people have now understood what debt mutual fund is.
Mm.
You don't have to start with the basics.
Mm.
Today, I don't want, I mean, have to educate people about SIPs, right? Everybody knows that.
Yeah.
I don't have to do that because everyone knows about. So maybe my work will become much easier because of so much media interaction, so much coverage, so much talks being happening. Now everyone who is the target audience understand the benefit of that mutual fund,
Understood.
and people have understood the benefit of asset allocation.
Right.
Earlier, especially in the tier 2, tier 3 towns, lots of intermediaries were selling only and only equity mutual funds.
Mm.
Now it will become easier for them to get a bigger wallet share, partly into debt, partly into equity,
Mm.
partly into multi asset kind of funds. So it will become much easier for them. Earlier, they were not getting 100% of the surplus money with them.
Right.
It will become easier for them. Of course, we have to reach out to more number of intermediaries because we basically are B2B. We are
Right.
not B2C.
Right.
Of course, with the direct class being there in Indian system. So B2C is very important. We will always welcome them, will service them. But as the penetration is so low, even if I want,
You will
I
depend
can't
on,
reach out to so
yeah,
many people.
and you will depend on
So
intermediaries.
I don't know, and this partnership is going on very very smoothly. This
Speaking of intermediaries and pivoting now away from debt mutual funds to talk about another aspect that the Honorable SEBI chairperson spoke about, which was the total expense ratio. And this is something that the SEBI has undertaken a study of. There were certain issues that she spoke about, principles that she spoke about. And while we're still awaiting the introduction of regulations, seemingly we're moving in a direction away from a scheme wise total expense ratio. Do you have any thoughts at this point as to how we could look at an asset specific, so across equity asset class, a total expense? Is this
I
feasible?
I don't know. I don't know what is in their mind. But see, of course, the economics come at the scheme level only.
Hmm.
Now, taking this example, I personally I don't know what is there in the
Sure.
mind when they talk about asset
Sure.
class. Uh, when you talk about, see, now we are the largest fund, right?
Hmm.
We'll be having overall very big equity assets.
Hmm.
But a scheme of mine, which is in a particular category, is 10,000 crore.
Hmm.
And suppose in that same category, another small fund is having a fund which is say 25, 30,000 crore.
Hmm.
And these are real numbers, right?
Yes.
By the way. If we go by asset class, our fund house with 10,000 crore will be charging much lesser expense ratio
Hmm.
than the expense ratio being charged by another fund house, which is very big on that particular category.
Hmm.
So it's the category only which has to be taken care of, not scheme, but category wise.
Okay.
So it has to be because and moreover, economies of scale don't work because the fixed rates are in percentage terms.
Sure.
For a smaller fund house, for a bigger fund house, for the asset class higher or lower, there are no economies of scale because the brokerage is being paid,
mm,
the assets being created, and the intermediary acquisition cost is same.
yeah,
If I am an intermediary, whether I am distributing for SBI mutual fund or HDFC mutual fund or a very small mutual fund which is having 10,000, his acquisition cost is
mm,
equal.
mm,
So it doesn't make sense.
mm.
So going by this logic, we will say that when LIC should be charging the least premium and the SBI should be charging the minimum rate of
Mm.
interest. So that I think that that doesn't work that way, and I really don't know what is there
There
in their
will be,
mind.
I'm
So
guessing,
so there are some issues, and
correct.
see, it's too early to talk about that
Yeah,
till the
because
time we go.
from what I understand, there's going to be a conversation with
No,
fund houses to
that will
understand. Yeah,
happen. And see, one good thing about SEBI is absolutely now they're talking. They are actually understanding the point of view and they are taking a view. They are just not say giving the regulation when मैंने कह दिया तो ये final आ गया. Not
because
that
I think
situation.
particularly for SBI mutual fund, one thing that could skew, especially the equity platform, would be the fact that a large amount of monies come in to your ETF, right, through the provident
Yeah,
fund, and
yeah,
so
yeah.
that would skew things
Yeah, no,
completely.
no. See, they're understanding this. See, I think when the conversation happen, see, they know and they will be listening and they will be taking a very cautious decision.
Mm,
See, I'm telling you, whatever the impression is outside, SEBI is absolutely reachable.
mm,
They are listening to the participants and they are taking very rational decisions.
mm. Now, another, again, a lot of my talking points are coming from that SEBI board meeting, and it has to do with private equity players now being able to promote mutual funds. As the largest player, and looking at this industry and having been a part of it for so long, do you think that this is a positive step? Do you think that consolidation could possibly take place as a result of the introduction of
No,
new players?
consolidation cannot be a regulatory
Sure,
requirement, but see,
as a fallout.
from regulator point of view, more the players, better innovations, better products. When some everybody comes with a different kind of expertise, why not to give more choice to the investor?
Hmm,
And see, there's thousands and thousands of niches of investors, niches of geographies. So more the merrier.
hmm,
And there's no way. I mean, if somebody has a particular thought process and they want to put it and they want to put their skin in the game by they feel that our strategy will work better and regular and it is passing through the regulatory filters. Why not?
hmm,
So they must have acted on some feedback, right? Some
yeah.
P's must be requiring, and see more than that, they have also a self-sponsored mutual fund as also been talked about.
Hmm.
Yet to see the fine prints, but all these are positive steps.
The industry is an extremely lucrative industry to be in. It's a sunrise sector. We're speaking at the close of a financial year. How has that financial year been for you? How do you rate it? Because the environment has been challenging, hasn't it?
No, there are two things. It's a sunrise factor because penetration is very low. More and more number of people are coming. But see, from the profitability revenue point of view, if you look at it over the period of time, the profitability has been under see pressure always. See, 10 years for now, the weighted average profit of the industry was around 60 basis point,
Mm,
which has come down to 16 to 18 basis point,
okay,
which has come down to one third
okay,
already.
okay.
So if you look at a very large player and not making even 15, 16 basis point as a profit, it's not a very good business. But the larger the size that,
Scale.
that it makes, because it becomes very difficult for the smaller players to do it. But in any case, smaller or bigger, so the intermediate cost is going to be high. It's very difficult for a player because everything is so transparent.
Mm,
A particular percentage of the TERs or distributable TERs goes to the intermediary.
mm,
So higher the DTR, higher the payout. Lesser the DTR, it's not that it's not the manufacturer driven companies, the distributor driven
mm.
industry. So going by that angle, I think one more players are always welcome. There's no doubt about it, and see things are going to be good only. And sunrise industry from the distributors from the investors point of view, that more and more people are going to join the bandwagon of the mutual funds.
Going by the trends that we've seen over the last couple of years, and I have data from March of 2022 from what the RBI has released in terms of share of household savings. At that point of time, less than 10% was going towards mutual funds. Over 50% was going towards fixed deposits. I'm guessing that has also moved up, inched up over the last 1 year, looking at the kind of interest that has been there. But do you anticipate, you said this at the start of the interview, that you still think that distributor driven model is going to be the way forward? At what point do you anticipate that people will come off their own volition, choose the direct platform, and will that change the model for mutual
No,
funds?
let me clarify. I didn't say it's going to be the intermediary or distributor driven model.
Okay,
It's going, distributors have enough number of people because penetration is so low.
sure.
Both will grow.
Okay,
Distribution led business will grow
okay,
and the direct business will also
sure,
grow.
sure.
The percentages may here and there, but the absolute number for any distributor, anybody can grow at a very healthy rate of 30 to 40%.
Mm,
And does that mean that the direct business is not going? Direct business will grow at a rate
much
of it
faster,
is
yeah.
much faster.
Mm,
So there's enough business for everybody on the
mm,
plate. We have to have distribution driven policies. We have to welcome the direct business this also. But there are intermediaries. If are there, they are welcomed by the investors in spite of paying higher cost. If they
mm,
are able to create value, they are able to take care of money in
mm,
a very active manner, then they are rewarded. There are examples where some see investors have moved from direct plan to regular plan also.
because of the
So
advice.
there are so many who have moved from regular to direct plan.
Mm,
But there are examples where people have moved from direct to regular also when they are getting a good wealth manager, good
mm.
distributor who is able to convince them that I will add value for you.
But sir,
People are ready to pay
the
that value.
contention and the worry is the bias that you might have as a distributor to say that मेरे को I'm getting a higher share here of profit, I'm getting a higher amount of brokerage. Why should I not sell this? And it's a good scheme. Between scheme A and scheme B, the performance might be 30 basis points apart. Why should I not choose this?
No,
Because
actually that's where the regulatory thing comes. And today the regulatory environment is such that with every increase in size, the TER is automatically coming down.
sure.
Just to give you an example, our weighted average expense ratio on equity fund was around 2.05%
Okay,
of 5 years ago, and which has come down to 1.6%.
okay.
This is a 45 basis points decrease because of the size going up.
Mm,
So this is automatic happening. That's naturally, if I'm charging 160, my distribution cost will be equally, right? But, but
fair.
but that's very well set system in the place. And then second, see, very low level, yes, there is a possibility that there could be a bias, but at the same time, they have to create value.
Mm,
This will be very short term.
mm.
If they are just selling a product which is giving higher fee, a good scheme or something, and then of course nobody will judge it. But if you are selling a scheme which is not a good scheme, but just because of the higher brokerage, it's not a very sustainable model.
Fair point.
And today, the evolved distributor, the good distributors, they don't look at it. They
Mm.
look at the
Performance.
investor performance and investor centricity. See, in any business. Till the time the end user interests are taken into mind, other things are very short term.
Mm.
And eventually, these are the self uh, killing kind of say policies.
Yeah,
Nobody can survive on that.
because ultimately this
Yeah,
is
you can't grow.
depending
You can't grow with
on
that.
long-term 10-year, 15-year,
Yeah,
20-year
yeah.
investments. I want to pivot now to the last part of this conversation, which is we're speaking ahead of what could be a very crucial Reserve Bank of India monetary policy review, and there is an expectation that we could see perhaps the last increase in rates. Would you call it? Would you say that we're almost at the peak?
See what happens in these cases. You generally go with the majority, and majority is saying so, and there are always surprises.
Yeah,
So you don't know and how the geopolitical positions are taken. Nobody is yes, but yes, the majority is saying so that this could be the last, because even Powell has said that it will be we'll have one more of 10 basis point, and it was so candid. Then thereafter, then it doesn't leave any judgmental
questions.
for
Yeah.
anybody. But Whether they will be able to do that or not will depend upon the situation at that point of time.
So,
So I think,
from what we know about monetary policy, and from what we have discussed on the change in regulations for debt mutual funds in terms of taxation policy, what then? And we've discussed that it doesn't really change your strategy in terms of asset allocation. From all of that, and from that perspective, what, according to you, is the best approach heading into the new financial year for those looking at investing in debt mutual funds?
see, see, debt mutual fund is a good way to have it. And today, any investor should have a very, very good mix of allocation towards the debt and equity both.
Hmm.
Debt, in my view, any individual will uh, be better getting into it through a mutual fund route because of two things: the active management which will happen at the fund manager level, which without impacting his taxation and all, that can be taken care of. Expense ratios are very, very reasonable,
Hmm.
and they will tend to get the valuation on daily basis,
Hmm.
and they will enjoy the liquidity.
Hmm.
See, now against this, whether going direct to the bonds or this thing, I will always prefer, not because I'm in the industry, but because of the hard work being done by the fund managers and making the liquidity available at the push of button on a digital asset, or just giving the redemption slip and next day money is in your account. So that kind of ease is nobody there.
Do you
So
think that that there will be a move towards hybrid, because there were few schemes that will not fall under the ambit of this new
no,
regulation?
there will be, see, hybrids in any case were there. For
Yeah.
example, conservative hybrid fund.
Hmm.
We are the ones who are propagating this for a very, very long time. This is a very healthy fund. We are having the largest fund in the conservative hybrid, which puts 75% into debt and 25% into
Hmm.
equity. And 70%, 5% debt
Hmm.
is being managed very, very actively.
Right.
So, what is the idea? Idea is to give high return, see, higher return than the fixed coupon product return, and provide liquidity.
Hmm.
So now in conservative, the existing conservative hybrid fund, that portion of the tax efficiency is gone because of the indexation.
Hmm.
But otherwise, 75-25% still exists.
But there are
Uh,
few hybrid funds which will continue to
yeah, the
enjoy
balance advantage fund is there. Balance advantage fund
indexation
is there.
benefits, right?
Equity saving fund is there.
Right.
Where there will be this, they continue to be enjoying this thing. That will become
More
much
lucrative.
more lucrative, more active. But then you have to take some risk in this.
Correct.
Otherwise, debt fund, people were taking zero kind of market risk.
Yeah.
Market, when they were taking interest rate
No
risk, but they
credit
were
risk.
not taking market risk.
Yeah.
Here you have to take some market risk from the equity, and that may
Market risk,
give
yeah.
you the higher return, or 1% higher, or 1 to 2% lesser return.
But then it doesn't make sense
Yeah,
to choose a fund just because of the tax
yeah.
aspect of it.
That's the taxation should never be the point. When you have to look at the asset class. So, and the second thing is, if you are making income only, then you are paying tax. Concentrate on your income. Tax, so in any case, is the part of the ecosystem.
On that very positive note,
Yeah.
thank you so much,
Thank you.
Mr.
Thank
DP
you.
Singh, for speaking to VQ Prime.
Thank you, Alex. Thank you very much.